Welcome, everyone, to another episode of Finance Village. I'm your host, Sheldon Bro, CEO of Pocket Finance. And in this episode, we're sitting down with the team from Kinsted Wealth to explore how financial advisors can unlock exclusive opportunities in private equity. I've got here with me Brent Knight and Brent Smith, also known as Handsome and Handsomer. I know they're probably wondering, well, which one is handsomer? Well, that's for you guys to fight over and figure out. Brent Knight is the manager of strategic partnerships. Brent has an extensive background in business development across industries like real estate, aviation, and he's got a broad perspective on how to help advisors leverage Kinsted's investments and opportunities to grow their practice. And one thing I love about Brent is he's easy to listen to, and he's not salesy. He really just is really great at communicating the value propositions of his firm. And Brent Smith, Chief Investment Officer with nearly 30 years of experience in global investment management, and he plays a big role in Kinsted's strategic investment decisions, huge contacts across North America, particularly in private equity and real assets. So we're going to start off with you guys, whichever one of you wants to tackle it, or if you want to do like a piece each. But start off by just telling us quickly about the creation and growth journey of Kinsted, how you guys started. And I know you've mentioned your leadership to me in previous meetings. So tell us a little bit about kind of where you guys started and the growth journey that you've had.
Well, I'm more the plus one here. Brent Smith is our Chief Investment Officer, so he'll be doing most of the commenting on our platform itself. So maybe I'll take that one on. I'll just tackle kind of a bit about Kinsted in a brief summary of who we are. As I was lucky enough to be here when we started the firm back in 2003. And where we are founded from is two partners that came from the big banks. One came, I won't name the banks, but anyways, they came from the big banks. And the thesis, because I did meet our founding partner, both of them on day one, when I said, are you crazy for leaving the big institutions and coming and building this from zero, was quite an interesting reaction. They basically said, no, not at all. We found that there's too many conflicts of interest in the big institutions. It's just, we wanted to build a firm the way we want our own money managed. And I know that sounds cliche, but that actually holds true. And I can go into numerous examples of that. But the whole idea was, let's build a firm from the ground up, and let's build it the way we want our money managed. So everything from holding your own stocks here as a client directed, no foreign exchange on US dollar or exchange for snowbird clients. The list can go on how we've kind of separated ourselves as a firm out there. So a bit about us. We've been around, again, started in 2003, built it from the ground up. We are now today just shy of 1.4 billion. So in the scope of things of financial services, that's not huge, but for us, it's a major accomplishment, and very proud of it. We're employee-owned firm, not owned by any large institution, and have been building it, like I say, built as a private client firm for individual private high net worth clients and families and institutions. And recently, we've been broadening that distribution network out with what's called third party, where advisors can buy it directly in some instances and hold it on their book. And we're also launching an offering memorandum just for distribution purposes, where people can buy our pools through different channels. So just to basically summarize that. We've been around 20 years. We built it from the ground up. In 2019, and I think part of the reason why we're here today, we brought this brilliant chief investment officer of ours on, Brent Smith, who basically overhauled our platform. And we'll get into that a little bit more, but what I mean by that is we really embraced the private markets. We've embraced that more pension style model, endowment model, because we believe that's the smart money out there. And we basically took our model and said, what's the smart money out there doing? And why are none of the big institutions doing this for their individual clients? And that's kind of where we evolved to where we're at today. And we're growing quite rapidly. We've increased our assets under management. I think we've tripled it since 2020. And so we've had great success both in the growth of our portfolios, thanks to Mr. Smith, and also from leveraging and having partnerships through my role.
Give us a quick overview, Brent Smith, of kind of for those advisors, because there's a lot of advisors out there that are younger advisors that don't necessarily want to take on that CIM or that PM role where they're managing the funds. They want to be able to manage the relationship, offer the additional value, do some great things for their client, but use a really sophisticated conduit like yourselves for the investment piece. But they may not be as nuanced or understanding. Again, this isn't for clients, so we're not going to dumb it down too much, but for the advisors that may not, have the sophistication around the public versus the private, give us a quick overview on kind of that differentiation and why you've chosen that path.
Sure. And I think I'm going to go into a bit of background before I answer that.
Please.
So just, my background was predominantly with Franklin Templeton, launched a very successful fund-to-fund strategy for Franklin Templeton back in 2002, moved from Canada down to the US as the chief investment officer for Franklin Templeton's multi-asset strategies group. By the time I left, I think we had about 40 odd billion dollars of AUM under management, predominantly retail assets. And why I think that's important is, I've gone through the tech bubble. I've gone through the financial crisis in 2008, 2009. And one of the things when you're managing money, you come to the realization that when shit's hitting the fan, there's very few assets available to you to really diversify your portfolios in tough times. And so after I left Franklin Templeton, it was looking for the right opportunity. And I was always a big believer in alternative types of strategies. And maybe I was a bit ahead of time because there wasn't the access to those was really limited. And and so when I joined Franklin Templeton, and I think Brent talked about, when I joined Kinsted, the intent was to really adopt a more of a pension style approach to wealth management, to really broaden out your investment universe to not just public stocks and bonds and preferred shares, but really broaden out the universe of investable investment options. And the only way to really truly diversify your portfolios is if you do embrace the private markets, right? And when I talk about private markets, I'm talking about things like private infrastructure and private real estate and private credit and private equity and venture capital and all of these esoteric or kind of niche areas that are incredibly difficult to access if you're just an individual investor or an advisor. And so one of the main reasons why investors or advisors should be looking at alternatives to enhance their clients' portfolios is twofold. One, they will help diversify your portfolio, and number two, not only will, in my opinion, will they see if you go into the private in just to the public markets and say, how do I enhance returns? Right? How can I enhance my clients' returns? Well, you have to go up the risk spectrum, right? I got to increase my equity exposure. That means I'm going to decrease my fixed income exposure. Or, you know what, maybe I'll go into the riskier segment and I'll increase EM or small cap. Well, automatically that's going to increase the risk profile of a client's portfolio. By embracing private assets, not only can you further diversify and lower the volatility of your client's portfolio, but at the same time, you're able to, in many, many cases, enhance the returns of your client's portfolio. And that's the whole goal of portfolio management. How can I, on the one hand, diversify, lower a client's volatility while also enhancing returns? And the only way you could do it is with private assets. You know, if you look at one of the things we do on an annual basis is look at capital market expectations, right? I don't know if anyone on the call looks at capital market expectations. You can get it from BlackRock. Every large institutional investor, institutional firm puts out capital market assumptions for the next 10 to 15 years. If you haven't looked at it, I think you're going to be pretty shocked. We were just looking at one very recently. Their expected return for global equities over the next decade is 4.3%. 4.3% for public equities over the next 10 to 15 years. U.S. equities, they've got about a 3% return. Now, it's going to vary by institutional firms out there, but on average, you're probably not looking at more than 4.5%, 5% over the next decade for public equities, right? So public equities tends to be the anchor to provide clients with those returns. Well, if you're only looking at 5% over the next, even let's call it 6 or 7 over the next decade, you have to embrace the private markets to provide enhanced returns. You know, if you go on to BlackRock, for example, just go on to BlackRock's capital market assumptions. It's available to anyone. The number one asset class from a return perspective is private credit. They've got over a 10% expected return for private credit over the next decade, right? You look at things like private infrastructure that's probably in the 8 to 9% range. All of these asset classes are targeting higher expected rate of returns than public equities over the next decade. And in many cases, a quarter of the volatility of public equities. So if you're truly looking to enhance your client's portfolio, provide lower volatility or enhance returns, you absolutely have to embrace the private markets.
Is there not a misconception sometimes that it's actually not that it's more volatility or that it's more risky?
Yep.
Or that because I feel that's, you know, I used to work with MUFG, one of the largest banks by assets. They do hedge funds. A lot of the most wealthiest people that I saw going through there were going in private routes. But I feel like with the not as sophisticated investor, or even with some sophisticated investors, or some advisors that haven't taken that opportunity yet, there is this misconception. Is that something that you run into a lot?
I'll bet you the vast majority of Canadian investors or advisors experience within. Let's just focus on private equity. It's because they were introduced to some small oil and gas firm or some very small firm, and it blew up and they lost all their money. And now I don't want anything to do with private equity. Well, the reality is, and here's a stat.
And it's funny that you mentioned that, because I've heard that exact scenario, those small stories in exactly that sector.
Yeah, exactly. And that's most people's, experience with private equity. And do you know that, and here's a stat that I like to throw out.
We love stats.
If you look at U.S. companies, be it private or public, right, that have revenue of over $100 million a year, and I ask people, what percentage of U.S. companies that generate revenue over $100 million a year are publicly traded? Most people think probably 80, 85. No, the reality is only 10 to 15% of U.S. companies with that kind of revenue are public. 85% of those businesses are private companies that generate over $100 million a year. These are not small oil and gas companies.
Most would guess the opposite of those.
Exactly, right? Exactly. So when you talk about private equity, we're not going out and picking and
Penny stocks is what
investing
people
in
are
a
thinking.
small little institution. We are partnering with some of the largest private equity firms in the world. That's their expertise. Their expertise is buying, a company, adding whatever value they do, and then selling it off in 4 to 5 years at maybe a 2 to 3 multiple on what they invested in it. Some of our private equity exposure, we've got probably $10 to $12 million exposure to SpaceX. Everyone's heard of SpaceX.
I think speaking as an advisor, I mean, over the last few years, I mean, one of the things I've been looking for my clients is alternative investments, because we all know the usual indexes and the public stock market that most advisors follow, but it comes with its own volatility. But then, depending on the kind of what your clientele is as an advisor, also determines what you should be looking out for in terms of where their assets are managed. And I find that, at least where I came from, most advisors are only focused on the public equities. But then when I look at some of my clients who are, call them high net worth clients, they've had experience with some of these things because they work in some of these private companies we're talking about. And so I guess my question here is, how do we give advisors, or how do we get this word out there to advisors that if you only focusing on public equities, and those public equities only make 20% or give or take of what's out there available for clients to invest in, there's another 80% that is not public. There's so much more return in those companies, and especially because their returns are not correlated to the stock market. So how do we get that message out there that there are opportunities to increase a client's potential returns without necessarily increasing their risk appetite?
Yeah, it's a great question. And kind of, how does the advisor that's interested in exploring that start that conversation with the client?
I think it's education.
Yeah.
Education is absolutely key, because it's such a, I think it all,
And how do you guys help with that?
When you just talk about privates, it's just privates is, first thing that comes to mind is private equity, right? And listen, I lost a shitload of money on private equity and blah, blah, blah. But I think education is so important. And it's that there's so many very large businesses that you can invest in. If you align yourselves with some of these top private equity managers in the world, like a Blackstone or some of these other premier private equity firms, that's what they've been doing for 20, 25, 30 years, right? Is buying businesses, working with the management team, turning their businesses around, selling it off in 3 to 4 years. I'll give you an example of one. Have you ever heard of Creed? It's a very high-end fragrance manufacturer. It's been around since the 1740s. BlackRock Long-Term Capital bought them in May of 2000. In May of 2020, they bought them for 350 million euros. It was a business that was owned by the 7th generation Creed family. It was basically being, I view it as it was a trust fund for the family, generating tons of cash flow. No thought went into it on how can we expand our business. BlackRock bought them, sold them, had a big marketing plan and other things around it. They sold it 3 years later at 3.5 billion euros. They did a 10x on that in just over 3 years, which gives you, this is why you have to partner with great firms as these firms bring in, it's not just writing a check, it's bringing in other aspects to help these businesses grow. Everything is, education is so key. Let's move away from private equity into areas like private infrastructure. We have an investment with this very large Australian. They managed about $50 billion in infrastructure. And when you think of infrastructure, how many of you would think that, IFM owns the Australian Sydney Airport in Australia, the Manchester Airport in Great Britain, the Vienna Airport. They own container ports, in Turkey and Poland, off the coast of Vancouver. They own toll roads. It's core, essential infrastructure that pays great cash flow. But most investors, when you talk about private infrastructure, probably don't know what that means. We've got exposure to the Abu Dhabi pipelines that pays out very consistent cash flow. So, private infrastructure happens to be one of my favorite asset classes because of the stability and how the stability of those cash flows, the stability of their performance. It's much easier to recognize or to factor in how repeatable those cash flows are. And so there's just so many asset classes within the private sector beyond just private equity that I comes down to education. And I know the biggest question is, yes, liquidity. Comes down to liquidity, right? There's no liquidity in these.
I've heard that conversation several times. That is, again, one of those, I think, misconceptions or speculations.
Sorry, Sean.
No, you actually beat me to the punch, because my question was, what's the most promise you've seen in private equity? You just mentioned in private infrastructure.
And the expectations about liquidity.
So, well, let me turn it around for a second and ask you, Sean, as an advisor, when you're investing in equities for your clients, do you tend to tell them you should view this as a long-term investment?
Absolutely. This is a 10-year, 15-year, 20-year timeline horizon. Yeah. This is not an investment you're looking to cash out in 3 years or 5 years. So
yeah, it's the same thing. It's the same thing with all of these privates. Maybe not so much private debt, private credit, because a lot of the terms are maybe 3 to 4 years. But when we're investing in private equity or private real estate or private infrastructure, the funds that we are getting into, they're different time horizons on some of these funds. But when you're committing to an LP structure, a closed-end fund with a very large organization whose market is the institutional space, these are 8 to 12-year term funds, right? But usually after 4 to 5 years, they start looking to sell off some of these businesses. So by the time you get to 12 years, there's probably next to nothing left within the fund. But we've structured our pools. It has to be done in a pool context. And the reason for that is because the minimum investment size for most of these institutional LP or limited partnerships usually starts at 5 million to 10 million. I've seen 20 million. So those are the minimum commitments. So the only way you can provide our clients with access to these institutional mandates is through a pool structure. So we've structured our pools where up to 60% of our pools can be in these kind of, we call it no liquidity at all, right? These are long-term investments. We know that we're going to hold them for 8 to 12 years. Then we have 10 to 15% in cash and cash equivalents, daily liquid, ETFs or whatever. And then we've got some that are 30-day liquidity, 90-day liquidity. So we do have that 10 to 15% liquidity bucket, which provides our clients with daily liquidity because our pools are priced on a daily basis. And now, we're offering those to other advisors and providing them with daily liquidity as well. And how can we do that? Well, we've got, let's call it $1 billion in 3 private pools where it's relatively sticky money. It's our private clients. We've got that direct relationship with our clients. And so we're now able to provide access to these pools to other advisors and providing daily liquidity, recognizing that, 60% of each of those pools can be or are in investments with a longer time horizon. But some of these longer time horizon vehicles, especially if you start talking about like private credit, or we've got private equity pools or private credit pools that are paying out 9 to 10% per year, right? These should be viewed as long-term investments. That doesn't mean you're not getting cash flow. Private equity secondaries, you could be getting 15 to 20% of your capital back on an annual basis. These are long-term investments. That doesn't mean you're not getting a return of capital over the short term.
That's a pretty good
And
point.
I want to give you the confidence of knowing just quickly here, Sean, that anytime that I've seen Brent kind of asked or questioned about the liquidity, he satisfies that, he crushes it. He answers it very well for the advisor, but he even answers it all of the things that he answers in a way that somebody like myself that comes from different segments of finance can easily understand it. And it makes you, excited as somebody that's, at the client level investor.
I want to jump in there because I think I heard you guys both ask a couple of things. Sean was saying, how do you get that out to the public and to clients? And I think I also heard, how do you position it as an advisor? So it's great questions. And I think the answer there is, what I've seen the most success, because I work with all of our partners like Sean and others on the advisor side, is going back to that education. So, first, like we get a lot of questions, who's Kinsted? I've never heard of you, which is fine. I mean, we're not a big splashy firm. We don't put our stuff on big billboards. We're a private client firm that's kind of built it that way, which is great, which is how we want it. When we get to the advisor partner level, it's really education our advisor partners on our platform, how it works, how the back end works, what the client sees, our portal. So we really want to get our advisor partners to understand our model. And usually most of them have met or been introduced to Brent Smith who can go into that depth on any of the strategies that we have. Then from there, the question is, okay, I love what you guys are doing. How do I position that to my clients? And, I say, well, first, once you understand our model and believe in it, I think we have all sorts of collateral. If you want to send something along to introduce Kinsted, I think we've done a great job in our marketing in the last few years, really picked it up in terms of positioning Kinsted, either by email or however you want to do it in person. But I think we're having great success with those advisors who are really positioning and say, I've got something to show you. I think it's worth seeing. It's something different that I've come across. It's something that is a broader playing field out there and in terms of what the average client's not seeing. So I'd love you to take a look at it. And when we do that that can be anywhere from a 20 to a 40-minute meeting. We try not to go too long because clients will eventually just zone out. They only can take so much capacity.
Take so much, yes.
For an intro meeting. So we try and keep it to whatever the advisor says. We look for, and we get to know the client. Like, what's been your investment experience? How's it been? Sean's told me, or we get that advice from Sean before the meeting in this case. And once we get a chance to talk to a client for 20, 30, 40 minutes and really get to know a bit more about them, their situation, and then tell them our story and how we built Kinsted and why, we've been very successful. It's not a hard pitch. It's not really at the end of that meeting, most clients are like, I get this. I really understand it. And, I appreciate my advisor partner for showing me this because I really didn't know this existed. And again, going back to that education, you want to separate what private equity really is, because most people have seen great marketing and lots of low barrier to entry and lots of problems. So that's been their experience. And really, we're the opposite of that. We're high barrier to entry, institutional, investing alongside endowment and pension plans. And I think for an advisor, you're showing your clients something that's really a differentiator. And for the end client, they're looking at it going, wow, I didn't even know this, this high quality private equity and infrastructure existed. So really, we've had great success growing our firm through our advisor partner channels and accommodating them however it is. Some use webinars, some use Teams Zoom, some like to sit across the table. It's really meeting our advisor partners where they need us to be for their clients, and then not hard selling our story. Our story doesn't have to be sold. We just have to be able to get in front of people and appreciate our advisor partners that say, love it. Let's get in front of clients. They can decide if this is the right fit for them. And in a large percentage of cases, it is because of the education side.
Very well said. And I want to pass it over to Sean in a moment here for a question that's very relevant to our times. But before I do that, I just want to ask you a quick question, kind of feeding off something that you both kind of made me think of. I also want to just maybe ask if we can have some type of marketing asset or something that we can attach to this podcast when we publish this, so the advisors can get a peek at something you guys are doing, some type of key piece of marketing material. But one of the things, give some advice, and I'll also prod you to, brag about yourselves and why you guys are a great choice at the end of this answer. But tell me, how does an advisor, give an advisor that's, let's say that there's an advisor that's, a young hotshot like Sean, just coming into the industry. He's starting to get a lot of connections, very popular person, getting lots of conversations, but they're like, okay, I'm intrigued with this now. I want to explore it. How would an advisor properly vet? Because not every person that's delving into this niche of the private side is going to be doing a spectacular jobs. There are, I won't say, ding dongs, but there's less than ideal opportunities in every segment of every industry that exists on this earth. Even if I want to go to a particular Costco, there might be a Costco that's better than the other ones, and that's the same company. So what advice can you guys give? And I'll let you each quickly take a shot at this, because I think that you could each give some insight into that. What advice would you give an advisor that wants to go through an interview process with, let's say, three companies that are focused on that private opportunity, that you give them to properly select them, and then brag about why you guys are great? Because we know that, and I've learned from some great conversations with you guys and others, that it's not just about this high level of competence of choosing and creating the portfolios and the funds, but it's also very much about what kinds of contacts that you have.
Yeah, I'll maybe take a quick shot of that, but Brent Smith's probably more apt to answer that. But from an advisor side, I think when you're looking at what, first of all, we never run down any other company. If an advisor is has Kinsted as one of their partners, and they have two other companies that sound the same, I'm okay with it. I'm always one for free market enterprise and finding where the right fit is for your client. And everybody's got their own niches, I guess you could call it, or their plus and minuses in some cases. So never want to run down, anybody on that regard, because we like advisors having choice, and we think Kinsted can be a great fit. And I think when it comes to Kinsted, and in terms of, how we're a little bit different, where we've been able to really set ourselves apart is going into our platform in more detail, so that advisors can get granular if they want and go, let's take a look at that strategic growth pool that you talk about, this amazing private equity. And why don't we go into that in a little bit more detail? And I've got a number of questions. You show me what's all in there. And we do that. Like, for us, it's all about
Okay, so let's highlight that keyword though. And again, when I said, I wasn't trying to prod like, knocking anybody, but
Sure.
That was a key thing that I have seen is transparency. Transparency is key, and you're not always going to get that to the same level.
Right. Yeah. I think transparency is the key. We're an open book, in terms of fee structure, everything that's in there, how those managers work, what they charge. So we don't want to leave anything on the table and skirt around stuff. We think we've got an amazing platform. And when we can really get in with an advisor, we can show them how we differentiate from, because a lot of firms look, sound, talk the same. But when you really dig into the platform, they're all a little bit different. And, I think Brent Smith and our team has done an amazing job of building our platform. And we love getting down into the granular with the advisors, say, this is what we think makes our platform different. Not only that, but if you choose us as an advisor partner, we're going to put a PM directly with you so that you've got a partner in those meetings. Our service team's going to do everything they can to make sure that that service goes well for your clients. So they're using our advisor partner well. Look, that's my entire role, is making sure our partners are looked after. And again, I'll maybe stop there and turn it back to Brent Smith, because I think it's just our platform that makes us a little bit different when people dig down into it. I don't know if you want to add more to that, Mr. Smith.
Yeah, there are a lot of great private asset managers out there. Listen, 5 years ago, there was next to no semi-liquid strategies. There was no semi-liquid private infrastructure, no semi-liquid private equity. There was a few on the private credit side, and then there was a bunch of smaller Canadian firms, right? And so if you look today, especially from the US, there's a proliferation of private credit funds. Blue Owl, Morgan Stanley, Oaktree, Blackstone. There's a lot of them out today. But not so much. There's a few on the private equity. There's very few on private infrastructure. And so if you're an advisor today that's just looking to dip your toe on behalf of your clients and go, where, I think I need private equity or private credit. I believe in it, but what do I select? So I think the risk, and it's got to be difficult as an advisor going, well, which one do I choose? Right? Am I making the right decision here? I don't want to blow my clients up by getting into another, bridging capital. What do I do? And so our approach and my approach throughout my whole career has been multi-manager, multi-asset strategy. So we are removing that manager-specific risk. We are removing that strategy-specific risk, because all of our private pools are diversified by manager as well as by investment strategy. So we're removing that risk. And I think removing that risk provides a bit more comfort for the advisor, knowing these pools. Listen, if you look at these pools, if you like to watch paint dry, these pools are perfect for you, because they hardly move day to day, right? They're not. You're never going to look at it one day and go, "Holy crap! It was down 3.5% for the day." It's not going to happen, right? It's just the nature of private assets, where performance comes in infrequent. And that's one of the beauties of private assets, is that, that less frequent performance statements leads to less volatility. We can get into, that it's not truly. Yeah. Anyway, sorry, go ahead, Sean.
No, in that vein. So
Very well said, Brent.
In that vein, what asset class would you say have performed well, looking at where we are economically, have performed well in inflationary periods like we are right now? Like, does that matter?
Yeah, I can give you a perfect example. In fact, I had this question recently from one of our wealth counselors' clients. Said, "Can you give me an example of one of your infrastructure holdings that benefited from higher inflation?" So when you look at, and it could be for private real estate as well, but from a private infrastructure, most private infrastructure managers have embedded inflation accelerators. So inflation goes over a certain rate, we are automatically our pricing will automatically increase at the end of the year. And so one of our funds, it's a Brookfield Super Core. It's just essential infrastructure. If you think of essential infrastructure like gas pipelines or utilities, that sort of thing, we actually a lot of their contracts renewed at the end of that last year because of these inflation accelerators kicked in, and we actually saw a bump in our performance in the first quarter as that kicked in. So you could look at real estate. If I own, if I'm renting this particular plaza, for my mall, they have inflation accelerators where automatically the fees, the pricing is going to go up because of due to inflation. So there's a lot of sectors that you're protected. Those fees or whatever the pricing will increase due to inflation. So you are protected to a certain degree in some of those areas. Not so much on public equities, right? But there's a lot of sectors there that you are protected. And you know what? What happens, and Sean, I think and Sheldon, what happened to traditional fixed income in between 21, 22, 23 as interest rates were going up. Traditional fixed income got hammered. Why is that?
Yep.
Because they had a fixed coupon.
Yeah.
So private credit, just from an education perspective, private credit had an absolute negative correlation with traditional fixed income. Why is that? Because 99% of private credit, or the stuff that we invest in, has a floating component. So there tends to be a fixed rate, usually anywhere, depending on the quality, let's call it 5 to 8% above a floating rate. 2.5 years ago, the floating rate was 0.05%. It got up to 5%. So as interest rates went up, so did the floating rate. So in a higher interest rate environment, private credit actually is a huge beneficiary because so that rate, think of a private credit deal that was yielding 2.5 years ago, 6% or 7% plus the floating. Yeah, still pretty good, 7.05. 2 years later, that same private credit deal was yielding 7% plus 5%. So you were getting 12% on that same thing that was paying you 7% 2 years before. So yeah, you are protected to a certain degree, or in a large degree, in a rising interest rate environment with private credit.
That makes a lot of sense.
So what would you guys suggest are some of the key factors to monitor over the lifespan of these long-term types of investments? What are some of the things that you're pulse checking on because you're obviously making a big decision up front, but then you're still monitoring over time?
Yeah, a lot of the homework goes on before you commit, because once you commit, if you're committing 10 million USD or $20 million USD, number one, it's not going to be called all at once. It takes several years before all your capital is being called. But you've got to, a couple of things we look at. Number one, what's their experience? How many vintages have they had? How many years have they been managing, let's say, private infrastructure or private equity? What has been their track record? Because you tend to see a lot of consistency, especially in private equity buyout firms. You tend to see a lot of consistency. If their vintage 2 was first quartile, vintage 3 was first quartile, you tend to see that consistency, right? So that's one of the things before we even commit to something is that, what has been their distributions of paid in capital over the lifetime of their various vintages. We want to see return of capital. their life cycles. But once you've committed, you're kind of stuck, right? So a lot of the work goes on beforehand. But here is why I think investors should recognize where, because I know over the past couple of years, there's not a lot of transparency in the valuation of these private equity funds. They can be bullshitting us. It's really not worth that. Well, their bread and butter of private equity funds, it's not about the last vintage they just raised capital for. It's about the next number of vintages. And if you overvalue your assets to bump up to inflate the value of that fund, and then you're starting to liquidate those positions, the last thing that these managers want is we valued it at $2, and now we've sold it, and it's actually, we have to write it down to $1.80. And sorry, Kinsted, the value that you did have is now going down. What are the odds of us committing to the next vintage? Next to nothing.
Unlikely.
Right? Next to nothing. So I would say that most managers that we deal with are very conservative when they value their assets, is because they do not want to have to write these down. And, White Horse Partners put a great report together back in the spring. They looked at 1,200, and this was private equity. I would say the same for private infrastructure, but it focused on private equity. They looked at 1,200 assets or companies that were sold over the past decade. They looked at what their prior marks were, i.e. what their prior valuation was, and what they were ultimately sold for. And on average, those 1,200 businesses were sold at a 28% premium to what their last valuations were. All right. So that is something that we monitor. If I look at it, because when we get our statements, there's lots of transparency. This is what the valuation of this company is. Okay, when you sell it, what's it being sold at? Is it sold at, it better be sold at a premium, not a discount. And I'll give you here another, one of our managers that we've got a great relationship with. I don't know how many people have heard of Schroders. Schroders is a very large European firm out of the UK. They got about $700 billion in assets, but we've got a great relationship with the private equity manager. And I recently had a call with him. I said, Christian, when you sell your assets, your holdings, from your experience, because he's been in the industry for about 20 years, I said, what has been your experience when you sell your assets? What type of premium do you tend to see? And he said, on average, we sell them at about a 25 to 50% premium over what we currently value them at. And he said, give you a prime example. That number one holding we have right now, I know it is being sold in the fall at a 35% premium over what it's currently valued at. So that's one of the things. Once you get into these, you're kind of stuck, right? There is a secondary market. I get that if we wanted to sell it, but we're never looking at exiting something in a secondary,
That's good, because you've still spoken to, there is a monitoring that happens. There is an ongoing communication that happens. And and even along with the transparency, there is overlap and even the separate thing of communication. And one of those things I'll highlight is, the communication is so critical in from marriage to business partners and everything else. And I will accentuate that because before I ever, like I said, bring somebody on the podcast, promote it to colleagues and stuff like that. It's not just about evaluating the competence and looking at that history, but it's also looking at the communication and even the heart of the people you're dealing with. I mean, you guys have good people that you've surrounded yourself with over there. So I want to finish up by quickly. I want Brent K for you to highlight one of your success stories. I want you to highlight one of your favorite success stories, Brent S. Give me a little tidbit on that legal one that was so interesting to hear about when we chatted that day. And then I'm going to let you close up, Brent, by highlighting if an advisor wants to get that first intro, have a chat with you, and get some insight and explore as to whether that could be a good fit for them, what that looks like, and how they can reach out.
Well, on my end, I'm not part of the investment committee, so it's probably Brent Smith that more has the success stories on our asset classes in there. But
okay, you're going to let them know how to connect at the end.
We've had, like my role is just, I like really getting in with our partners, and we've seen some very interesting ones, everything from credit unions, First Nations, how do I call them? We got a very eclectic group. And what's highlights for me is when one of our partners, and I know this is different than probably what you're asking, Sheldon, but I'll go on this tangent briefly and then
turn it over. If you see it's meaningful, do it up.
What's really exciting to me is when one of our partners introduce us to another partner. Going back to that, you start from who's Kinsted, don't know of you guys, so tell me a bit about, you got to earn that trust, got to really build out that partnership, and you got to say what you do. You got to have that platform that they believe in. You got to have that service, that communication, like you talked about, and you really got to look after your partners. And in return, you got to look after their clients. It's important. If one of those steps gets missed, or you drop the ball consistently, you're finished. I mean, not only are you finished with that advisor, they're never going to refer you on to anybody else. So in my role of partnerships, it's getting in with advisor partners, having them understand our platform, doing great things for any of the clients that they bring on, and having them come in and say, you know what, I want to introduce you to 3 other people that, and I try and do the same for them. If I can connect them to other people that can help them grow their business, that's my thing. So I don't have a specific investment story. I'm sure I could pick one up. I know our platform fairly well, but not as in depth to go into like Brent Smith. But that's really what excites me, is just getting out there, telling our story, educating advisors on our platform. And if they like us enough that they refer somebody else, I can't ask for anything more from my end and my role.
It's funny. I think that's how we met, actually. Sheldon introduced you guys to me.
That is
and
how
then
we
I
met.
ended up introducing you to my other business partner. So
That's right. Yeah. And that's
keeps
how it
rolling.
works. And, I appreciate that. I appreciate guys like yourself, Sheldon. You basically came to an event that I hosted and introduced you to a number of people that I knew that I thought would be great for your business. It was just more of a casual thing. And from there, you got to meet Brent. Had that kind of East Coast connection there with his daughter living out east and family out there. And you guys just connected. And from there, I can't thank you enough for introductions to Sean and others. It's been a great part of our growth of our business, quite frankly.
And before I go over to Brent S. for the just one quick highlight of one of your maybe favorite success stories and touch on that legal one that I love, I am going to quickly plug our sponsor, Pocket Finance, that the greatest deterrent to creating a financial plan is the effort required to gather data. And statistically, that's the easiest one probably to measure. But the greatest deterrent to doing something meaningful with your finances, whether it's and this carries over both to the client and to the advisor, is trust. It's warm referrals over everything for me. I would prefer never to deal with another cold lead as long as I live, because if you can and you can carry that over to so many aspects of life. I mean, how many people have gotten married because they were introduced by somebody that already kind of knew both of the people and felt like it would be a good fit, and had confidence in what they're going to be able to offer. So warm introductions are king, and Pocket Finance is something that really accentuates that. And hopefully we'll continue to do so and even have some opportunities to do so with Kinsted in the future. Brent, give us a little bit of that wrap up with maybe one of your favorite success stories and tell us about that really interesting opportunity that you uniquely have access to in the U.S.
Yeah. You know what? This is we got access to this opportunity because of prior relationships when I worked down in the U.S. And this is just an incredibly unique investment opportunity that I tried Googling how do I get access to corporate litigation and antitrust, and it's like there's literally nothing available out there. Anyway, I won't go through the details on who's managing this because they're very, very high-end lawyers. But it's called the Legal Opportunities Fund. Its success is not today, but it's going to be over the ensuing years. And I think this is going to add tremendous value to our strategic growth pool. We've committed $20 million. They are targeting a 3x on committed capital, meaning if we commit 20, we're looking to make 60 million out of this. It's patent litigation, it's antitrust, patent litigation. These are not small. This is not ambulance chasing. These are very large institutions being sued by a litigant who believes their patent has been infringed upon, and in most cases, the courts, go down in their favor. But I'm just going to give you a couple because we just got our quarterly statement recently, just to give you a flavor. I know that one of the cases that they're working on is going to trial, and I can't mention the company being sued, but it's a very, very, very large technology company that is being sued by the state of Texas for antitrust. Okay. But I'll give you, because I just read the report recently. So right now they have 10 cases that they're working on from May 31st, 2022, all the way to May 24. They're looking to build up a portfolio of about 40 cases. So, and I'm just going to read you a bit of, and this will kind of really shock you. It says the fund. So, for instance, as of June 30th, the fund had deployed $4.9 million into case 2, which is a patent infringement. So $4.9 million in anticipation of a realization in early 25. The fund has marked that position at $18.3 million. This is a $4.9 million that they've committed to. It's going to be marked at an 18.3. Similarly, as of June 30th, the fund had deployed $9.4 million into another. I think that was a digital regulatory case. They committed 9.4, and in anticipation of a realization before the end of 2024, that 9.4 million has been marked at 37.8 million.
So clarify for me. These are cases that are being scrutinized and vetted as being a highly likely to win case. Mm-hmm. The money is being lent to pursue those cases.
That is correct.
That is so unique and interesting. And now, even though I couldn't remember exactly what it was, it even feels like twice as interesting hearing it the second time.
Why would a firm let some other law firm provide that or give them, X money and then take a big chunk of that winning? So no, I don't know. It's not like the firm lending that money is taking all of the proceeds. But think about some of these small firms just don't have the working capital to fight these cases in court, and that's where a firm like Pretium that we deal with provides that basically legal capital, if you will, to be able to fight this. Now, there is zero downside for that firm, right? If they lose the case, it's the firm, it's us as holders of that fund that lose out, right? It's not so there's really no downside for the firm, but it's one of these it's one of these funds. It's not 100%. It's going to be maybe. I'd love it to be 5 to 6%, 7% of our pool. But it's something that because there can be outsized gains, that I think it will add several hundred basis points per year to performance in a very small, with a very small exposure. So I mean, there's lots of other examples of pretty unique investment strategies out there that most people have never heard of.
I didn't even
That's
conceive before we had that conversation that it could get that interesting.
Oh,
that's a very interesting concept.
It's phenomenal.
Never heard of that.
And I'm going to throw one last one out, and you can edit this out if you want to. And one of them, it's called CLO, or collateralized loan obligations equity. And I'll finish with that. It's structured along different tranches: double A, double B, A. The double B tranche of a CLO collateralized obligation a year ago was yielding 16%, was yielding 13.5%. The equivalent credit rating in corporate bonds, double B to double B, the corporate was yielding about 7%. You can get the identical credit rating of a CLO that was yielding 6.5% higher. And what they call it is the complexity premium. We've heard illiquidity premium. There's something called a complexity premium where the marketplace just does not understand the asset classes. And if you understand it, you're picking up 600 to 700 basis points of excess premium just because of that complexity premium. So there's lots of investments out there that none of us have heard of.
Well, I'm going to ask you one more wacky question in relation to that. It's just a short answer question, but suppose there's a wacky guy out there like me, and I have some amazing exit from a startup, and I now want to take 25% of my exit, and I was to come to you and say, Brent, I trust your fund building skills, but when you told me about that legal fund, I want to go all in on that. Is that something that you would allow me to do?
Unfortunately not, because it is part of our pool. It's a component of our pool. It's a component, you've heard of the expression death by 1,000.
Because you're not trying to run a casino. You're trying to run a, as we said, boring, reliable fund.
I mean, and you look at a strategy like that and you go, what's the correlation with the economy? With anything? There isn't any. So, there's going to be times where things are not firing on all cylinders. And I think this legal ops fund will provide very consistent return to the portfolio, while there may be other things in the portfolio that are not doing as well. And so it's just part of a diversified pool.
And one interesting part of that, just quickly before we finish up, is that I would have to assume, logically and intelligently, that as they continue, because with law, there's continually more precedents being set, there's more understanding being gained. Their ability to vet those cases, I would expect, is increasing in its quality every single year.
Well, just to put it, just to let you know, the guy running this was the administrator. He's a lawyer, very well-known lawyer in the U.S. He was the administrator of the Lehman Brothers Trust, helping to liquidate the Lehman Brothers Trust. By all accounts, I think Lehman Brothers Trust wrote out something like $200 million in legal fees. And it's a business that it's lawyers who know lawyers. It's who you know that presents you with these opportunities. It's like
good. Well, perfect place to close out. So, Brent, I'm going to let you take this last part. If you either have to tell us how people can best connect with you, otherwise we have to assume it's by calling 1-900-handsome guys and girls.
Wow. No, to connect to us, like we're Kinsted is the name of our firm, obviously, that we've been talking about here for the past hour. Our website's www.kinsted, KINSTED, not with an A in it, .com. And people can get a hold of me. I have no problem sharing my contact information. We got Brent at Kinsted down below, and you got brent.knight@kinsted.com above. And, people can get a hold of me through your podcast, through you or Sean. can look us up on the web and get a hold of me anytime. What we usually like to do for any advisor looking to talk to us is set up an introductory meeting, 15 minutes, 30 minutes, just do an introduction, find out if we could be a fit for advisors out there, and direct clients, obviously. But yeah, appreciate being on the podcast, and easy to find us on the web and on email. So we love getting out there and appreciate being on here with both of you today to tell our story. That's a big part for our growth. It's just getting out there and telling advisors and the general public our story.
And I'm going to give my final hard fisherman's nudge that I like to give it a lot at the end of podcasts, and let Sean get a final word, is that, we tell clients, and I just, and I don't sell insurance, but I'm one of the biggest advocates in the country for insurance. I've seen all the horror stories with friends, family, colleagues. We would just want a lot of the time for people to take the 15 minutes to get the information. We push our clients to do that. Let's be smart as professionals and be open to those opportunities. And you guys are a killer team. Have that preliminary conversation with Brent. There's no salesiness. And like you said, there's no hard sell that you're telling. There's a good foundation that you're able to stand on, and it's all about education. So book your 15 minutes, have a quick chat with Brent K. Then you'll have the privilege to probably have a follow-up chat and get some really awesome insight and further detail from Brent S. And we appreciate you guys taking the time. We're all working to get time back in our lives, and appreciate you taking a moment to give it to Finance Village, and hopefully a great benefit for the advisors there. And Sean, if there's anything you want to close out on.
Nothing much to add other than I can say the experience working with Kinsted has been great. It's been pleasurable. Brent has met with my business partner and I on many occasions to talk strategy and looking out to what to do best for our clients. And there's never been a hard sales pitch. There's never been a hand wringing or marketing. It's just been straightforward, plain talk, and that's what our clients need. And so I can definitely vouch for Kinsted.
Appreciate that, Sean.
Yeah, appreciate
Thank you guys,
that.
and thank you everyone for joining another episode. 92% of people trust referrals from people they know. But there's a better way to make those introductions. Wrap your arms around your client with your professional team. Join your client's team free today. PocketFinance.com.